Welcome to the Deep Dive. We're your shortcut to getting up to speed, blending facts with hopefully enough interest to keep you listening.
Absolutely.
So today, we're tackling a real head-scratcher from the market. How does a company like Monday.com, ticker MNDY, beat Wall Street estimates, report strong Q2 earnings,
Yeah, really strong numbers.
and then see its stock just plummet? We're talking a staggering 27% drop on August 11th, 2025.
It's pretty wild, isn't it? A classic paradox.
It really is. So our mission today is simple. Unpack Monday.com's Q2 results, figure out what was in that guidance they issued, and understand this huge disconnect.
We've got their official press release, the investor slides, plus some takes from Investors Business Daily and the Motley Fool.
Right. We'll sift through it all, pull out the key financials, the strategic bits, how the market reacted, and really try to get to the rye for you, especially if you're an investor watching this space.
Makes sense.
Okay, let's unpack this then. How does a company beat, yet the stock tanks so hard?
Well, it's the kind of thing that definitely catches your attention, especially if you're an experienced investor. The market reaction was immediate and pretty brutal.
Brutal is the word.
MNDY stock just plunged 27% down to $180.36 in morning trading. That could even be a new 52-week low.
Wow. And that's even starker when you think before this, the stock was actually up 5% for the year, right?
Exactly. While the broader tech software ETF, IGV, that was up 9%. So Monday.com was already lagging a bit, but this drop, it really stands out.
It really does. So a massive haircut for anyone holding the stock, especially jarring when you look at the actual Q2 numbers. They seemed, well, pretty good on the surface.
Undeniably strong, I'd say. Revenue hit $299 million for the quarter. That's up 27% year over year.
And that beat the analyst estimates, which were around $293.6 million.
Comfortably beat them. And then you look at profit, their adjusted profit, the non-GAAP number that gives a cleaner operational view came in at $1.09 per share.
Which was up 16% from last year.
Right. And analysts were only expecting something like 86 cents. So they absolutely crushed that prediction.
Okay, so strong revenue beat, massive profit beat.
Yeah.
What gives? Is the market just, completely overreacting here?
Well, it's fascinating, isn't it? Because yes, the Q2 numbers themselves look great, but the market is always looking forward, not backward.
True.
And one analyst, Derek Wood from TD Cowen, he pointed out something interesting. He said this was actually Monday.com's smallest percentage beat, just 1.8% on revenue since they went public.
Ah, okay. So maybe expectations were even higher, or perhaps the quality of the beat wasn't quite there.
Perhaps. But even so, that 1.8% beat doesn't really explain a 27% drop. It clearly points to something else.
Yep.
It raises that key question. What did they say about the future that just spooked everyone?
And that's the critical piece, isn't it? Especially for you, the forward-looking investor. It wasn't the history, it was the forecast.
Exactly. The core issue was the guidance. Management's outlook for the rest of 2025, it hinted at a, quote, slackening of growth.
A slackening. That sounds like Wall Street speak for hitting the brakes.
Kind of, and that's what rang the alarm bells.
So is 26% growth really that bad? I mean, for a company this size, that still seems pretty decent on the surface.
It's all about context and narrative. For Q3, they're guiding for revenue between $311 million and $313 million.
Okay.
That's about 24% to 25% year-over-year growth. Still good, but a definite step down from the 27% they just posted in Q2.
Right, a deceleration.
And for the full year 2025, they're projecting revenue of $1.224 billion to $1.229 billion. That works out to roughly 26% year-over-year growth.
And that 26%, when you put it in context, wasn't growth over 33% last year, fiscal 24?
It was 33.2% last year, fiscal 23.
So yeah. For a stock that's priced for hypergrowth, seeing that projected growth rate dip from 40 down to 33, now down to 26, even if it's still healthy growth in absolute terms, it signals a trend change.
Precisely. It's a significant deceleration, and it's not just the top-line revenue growth.
Okay. What else? Their full-year non-GAAP operating income margin is guided to around 13%. And maybe more critically, their adjusted free cash flow forecast.
Right. Cash is king.
Always. It's projected at $320 million to $326 million. Now, the key here is the margin that works out to an adjusted free cash flow margin of 26% to 27%.
And how does that compare?
It's slimmer. It was 30% in FY24 and 28% back in FY23.
Okay, so slower revenue growth and a slightly less efficient cash generation profile, at least based on the forecast.
Exactly. So the market isn't just reacting to one number. It's reacting to this perceived shift in the whole growth story, the narrative. plus that slight tightening of cash flow efficiency.
For these high-growth tech stocks, any hint that the trajectory is flattening out, even a little, can trigger a really outsized reaction.
It's almost like a grow faster or else mentality sometimes.
So for you listening, it looks like investors just zoomed past the strong Q2 beat and fixated entirely on that projected slowdown. It really shows how much future expectations drive these growth stock valuations.
Absolutely. Past performance is nice, but the forecast is what moves the needle.
But is the market maybe missing some underlying strengths here? Is there more to the story beneath that headline guidance?
Well, that's where digging a bit deeper into the financials and the growth levers really pays off. Because despite that guidance shock, there are definitely positive indicators.
Like what?
Let's talk net dollar retention rate, NDR. How much existing customers are expanding their spending year over year.
Crucial metric for SaaS companies.
Totally. Their overall NDR, that's a trailing four-quarter average, it stood at 111%, which is,
Wow,
solid.
actually 111%.
But here's where it gets more compelling, especially for thinking long-term. Look at the NDR for their bigger customers.
The enterprise segment.
Right. For customers with 10-plus users, NDR was 115%. For customers spending over $50,000 in annual recurring revenue, ARR, it was 116%.
I think better.
And for their largest clients, those over $100,000 ARR, the NDR hit 117%.
Okay, that's interesting. So while overall growth might be slowing, the biggest, presumably most valuable customers are actually sticking around and spending more.
Exactly. It paints a picture of real product stickiness, especially upmarket. They're embedding themselves deeper into these key clients. That suggests long-term value creation that maybe gets lost in the short-term reaction to guidance.
Yeah, that's a quiet signal that often gets overlooked.
Yeah.
And does the customer growth data back that up? Are they landing more of these bigger fish?
It seems so. Their overall customer count was around 245,000 at the end of last year across tons of industries. But the real movement is in those larger accounts.
Let's see the numbers.
Customer spending over 50K ARR. That number jumped 36% year over year. It's over 3,700 accounts now.
36% growth in that cohort. Nice.
And those customers now make up 38% of Monday's total ARR. That's up from 33% just a year ago.
So the revenue mix is shifting towards larger deals.
Definitely. And it's even stronger for the $100 plus ARR customers. That cohort grew 46% year over year to over 1,400.
46%.
Yeah. And they now account for 26% of total ARR, up from 21% last year. Plus, they added a record 144 net new customers in that $100 K plus bucket just in Q2.
Wow. Okay, so that's a really strong signal of enterprise traction.
Yeah.
Landing bigger deals, those customers sticking around and expanding. That's a powerful long-term trend.
It absolutely is. Larger customers usually mean lower churn, higher expansion potential. It's a definite positive.
And financially, beyond the guidance, they're still pretty solid overall.
Oh, yeah. Fundamentally strong. Non-GAAP gross margin in Q2 was 90%. That's exceptional for software.
Top tier.
Right. Non-GAAP operating margin dipped slightly, 15% versus 16% last year, but still very healthy. Adjusted free cash flow for the quarter was strong at $64.1 million, a 21% margin.
And their cash position.
Grown significantly. They ended Q2 with $1.59 billion in cash and equivalents. That's a very comfortable cushion.
Provides a lot of flexibility. And they're still aiming for that big long-term free cash flow goal, right? Over $1 billion between 23 and 26.
Still on target for that, according to them.
Yep.
Yes.
Okay. And looking at how they're spending money, the operating expenses. We saw R&D went up as a percentage of revenue.
That's right. R&D climbed to 20% of revenue, up from 16% a year ago. That clearly shows increased investment in the product, in innovation.
Which makes sense given the push into AI and new products we'll likely talk about.
Exactly. And meanwhile, sales and marketing S&M actually came down as a percentage of revenue. It was 47%, down from 51% last year.
Suggesting maybe some gains in efficiency there, getting more bang for their marketing buck.
That's likely the goal. It suggests a strategic reallocation, spending more on building the future product, maybe becoming a bit more efficient in acquiring customers.
And they're still hiring too.
Yep. Headcount grew by 172 people from Q1, reaching almost 2,900. And they plan to grow headcount by about 30% this fiscal year, focusing on sales, R&D, and product.
So definitely investing for growth despite the moderated guidance.
Precisely. They're funding that future growth trajectory.
Okay, so it seems like they are playing the long game here, which leads us nicely into what they're actually building. What's the strategy? What's new?
Well, conceptually, they talk about shifting from just work management to something broader, work execution.
Work execution. Sounds more active.
It does. They're positioning themselves as the central work OS, the operating system for how work actually gets done in a company.
Sort of the central nervous system for workflows.
Kind of, yeah. And a huge part of that is powered by their AI initiatives.
Ah, yes, AI. Everyone's talking about. What's Monday doing?
They've rolled out a few key things. There's Monday Magic, which uses prompts to build custom solutions like, say, a real estate management setup.
Okay, generative AI for workflows.
Then there's Monday Vibe. They call it a vibe coding platform, which sounds a bit unique. It lets users build secure, custom business apps, seemingly with less traditional coding involved.
Interesting. Low code, you code with an AI twist.
Seems like it. And finally, Monday Sidekick. This is pitched as a personalized, context-aware digital assistant to help users proactively.
Like a Clippy for your work management. Hopefully better.
Let's hope. But seriously, the adoption seems real. They mentioned about 46 million cumulative AI actions since these features launched. That's a decent engagement number.
Yeah, 46 million suggests people are actually using it, not just a gimmick. And they're expanding the core product lines too, right? CRM, service, dev.
Big time. Monday CRM just hit $100 million in ARR. That's impressive growth, reaching that milestone only 3 years after launch.
Wow, $100 million ARR just for the CRM part.
Yeah, and the number of CRM accounts is up 61% year over year, over 33,000 now.
And the other products?
Monday Service for customer support teams saw accounts jump 45% just from Q1. They added multi-portal support, which is key for larger enterprise users.
Good enterprise feature.
And Monday Dev for software teams saw accounts grow 72% year over year to over 4,600. They're adding features like sprint capacity planning there.
So clearly broadening the platform's appeal across different departments.
Definitely. And they're layering on more enterprise-specific capabilities too, things for leadership visibility, standardization, resource optimization. They said nearly half their enterprise accounts have already adopted these.
Shows those upmarket efforts are resonating.
Seems so. Plus, their ecosystem is growing marketplace apps, channel partners, referral partners. It all feeds into the platform's value.
And that workflow builder sounds like it's catching on.
Rapid adoption, especially in enterprise, tens of thousands of active workflows. They're even bringing a limited version to the lower pro tier soon.
Spreading the automation capabilities. They also brought in a new CMO.
Yeah, Harris Baber comes with a strong background, Google Workspace, Waze, Vimeo, over 20 years of experience. Signals they're serious about scaling their marketing and brand.
Okay, so lots of activity. Heavy investment in AI, expanding products, pushing up market, strengthening leadership. It sounds like a company building for the future.
That's the picture they're painting.
But for you, the investor listening, the big question hangs there. Will all this translate into re-accelerating growth? Or at least better growth and margins than the current cautious guidance implies?
That's the million-dollar or maybe billion-dollar question. Is the market right to be spooked by the guidance, or is it missing this underlying innovation and upmarket momentum?
Brings us to the market commentary. What are others saying? How does Monday stack up?
Well, it's a competitive space. You've got Asana, Smartsheet, Atlassian with Jira and Trello. Lots of players.
Right.
Investors Business Daily, IBD, their ratings aren't exactly glowing right now. A composite rating of 61 out of 99, which is okay, but not great.
And the key one.
The accumulation distribution rating is a D-. That basically signals heavy institutional selling. Big funds were likely heading for the exits after that guidance.
Okay, so the institutions reacted strongly, driving that sell-off.
Yeah.
What about other perspectives? Motley Fool often takes a longer view.
They do. Scott Levine at the Motley Fool suggested the market might be, quote, overreacting.
An overreaction.
His argument is that even hitting the lowered 2025 guidance still means pretty strong revenue growth, that 26%, and a healthy free cash flow margin. He implies this sharp drop could actually be a, quote, great buying opportunity for long-term investors looking for tech stocks.
So one view says institutions are bailing, another says maybe this is the time to buy the dip if you believe in the long-term story.
It perfectly highlights that classic tension, doesn't it? Short-term market sentiment reacting, maybe overreacting to guidance versus the underlying business fundamentals and the longer-term potential. That D rating shows the immediate pain, but the fool's take encourages looking beyond it.
Okay, so let's try and summarize the key takeaways from this deep dive for you.
Yeah.
Monday.com posts strong Q2 results, beats on revenue and profit.
Yep, clear beat.
But they issue cautious guidance for the rest of 2025. Slower projected revenue growth, slightly slimmer free cash flow margins compared to previous years.
And that guidance is what really hit the stock, triggering that huge 27% sell-off.
Right. But beneath that headline, the company shows strong progress with larger customers, great growth in 50K and 100K AR accounts, and those customers are expanding their usage, shown by the high NDR rates.
Plus, they're investing heavily in the future AI features, expanding the Work OS with CRM, service, dev products, and really focusing on that enterprise market.
So you got this picture of solid current performance, clear strategic investments for the future.
Butting up against market expectations that just got reset lower because of that guidance.
It really reveals how delicate that balance is between what a company's doing and what the market expects it to do next.
Especially in this high-growth tech sector.
So the final thought for you to chew on. Is the market's sharp disappointment here an overreaction? Is it just turbulence as a high-growth company matures into a slightly slower but still healthy growth phase? Or is it actually an early warning sign of tougher competition or execution challenges ahead in this crowded software space?
That's the question investors need to grapple with now. Is this a dip worth buying or a sign to stay cautious?
Something to definitely mull over. That's all for this deep dive. Thanks for joining us.